Walaikum Assalam. Before starting today, maybe I will take another 2 minutes so other participant will join. But what I want to ask, with reference to the last session, anybody have the question? Did you go through later on that same topic, unrealized gain and losses? Do you have any question on that? I received, I think after the session, one question from one of the participants, maybe Ms. Farhana. Ms. Farhana, I'll appreciate if you share your question the same here today. So we'll reply on that also. Yes, in the last session, one of participant, I asked specifically the same point. I appreciate if anyone would like to come forward and willing to answer on this or clarify this point. Please quickly make the in chat comments. I'll open the mic for you. Okay, I'll just quickly, I was expecting the good response on this point because we already have the discussion on that. Let me share the slide. Okay, in the last session, while discussing the realized and unrealized, we seen the corporate tax return, the same point also. This is the point that Ms. Fana has raised the question. Yes. Yes, the taxable person, a bank or insurance provider, yes, they are applicable on them also, but for them is only one option is available. Yeah, Ms. Farah, in the previous session also, we requested the day that we have the online session, you raise the question the same day, or after the session, you raise the question. This is the one of the, the appropriate way, because why restriction is not, we are putting the restriction, this is just having the comfort for all of the participants. Because if someone send the message today, someone send in afternoon, someone send in the afternoon, so all the participants, they will seek the notification and they might not comfortable with that. This is the only the objective. So that's why the time limit, the same day when we have the session, before session 2 hours, 3 hours, we may consider like that, or after the session, immediately after the session, when you finish the session, you just put the question. Okay. In this way, we will have the limited time, so everybody mindly prepare. Okay, for this text online training session, these are the questions are coming. But if we're sending all the day, and that will be maybe annoying. Most of the people are busy in their routine life, in the practical office life or personal life. So this is the only the objective to, where we are requesting avoid frequently sending the question. On the other side, yes, even you shared the question with me also. In my mind was there your question. So that's why I asked the same question, because I have even I'm receiving from other participants also. So that question will be with me, and during the session I will try to answer on that also. But apart from that, we'll try to answer on that, but not very frequently, because many question we are getting receive on that, so it will not be easy to continuously reply on one by one. So that's why we are getting the question before even the session. I'm just looking the whatever the question I received, so I will try to answer on that. Anyhow, let's come quickly to this point. See, the depreciation and revaluation, it is the same for the other industry also. Only see, the impact is that even which option is available for the gain and the losses on realization basis. If we choose the option, if we opt the option for the gain on realization basis, gain and losses on realization basis, the next question, this election we will opt. If we say no, then no other question will be appear. But if we say yes, then the below additional question will be appear. Are the taxable person is a bank and insurance? So if we say no, so then we will receive the two question. Okay. All asset and liability, again, I'm just quickly, all asset and liability, where we said the option A, and the all asset and liability held on the capital, where we said only the option B. Now, I'm just going to quickly, the next question where you will see if we say we are not the taxable person is not the bank and insurance, in case no two options shown for selection based on the company tax planning, can opt only one irrevocable. During the first tax return election to be opt, election may be give cash flow benefit. This is maybe other benefits based on organization to organization may vary, but this is just for understanding one of the example we added. So these are the two options that we go through very detailed in the previous session, and here I'm just trying to answer on that. Where we mentioned the yes, only then there is no further option for the okay. Here we are opting the no, but if you make the yes, then these option will not appear. By default, only option B will be appear. By default, option B will be marked for them. Okay. So option A will not be available. The current asset or the revenue asset, sorry, the revenue asset that option is not available. Only the option B for the capital asset is available for the bank, and only bank and the financial institution and the insurance. If we take the exact word, hope this point is clear. Now today we just want to see which topic we are covering, and we'll see a couple of examples. So this questionnaire will be covered, because in last session we covered only the theoretical part. For understanding part, we have the detailed understanding. This is the topic that what we are discussing now. Fifth adjustment out of 8th adjustment, unrealized gain and losses. We've seen that realization basis. Ms. Farhana, would you please confirm? Hope your point is clear. Yeah, thank you. Here we, if no, okay. Here we are discussing the fifth point, and we are discussing on the realization basis. So we already seen the quickly. I'll just go through and just a refresher. Option A, we discuss all asset and liability, and where is the current asset? Current asset means the revenue asset. Non-current asset. Non-current asset means the capital item. Capital item, land, building, plant, machinery, investment property. or the second option, because one of the option we have to see, that is the B option. This is the A and B only for our understanding. There is in the return or in the taxation, there will be no A and B. Only a capital item. Okay, here the asset and liability both are covered. Even we're talking about here, if you see as all asset and all liabilities, okay. Here we mention only capital item. Here also it is the same way, long term asset and liability. Here we have the understanding where we're seeing the which standard is covering this part, accrual based accounting, fair value model, revaluation model, record asset plus liability in the financial statement, market value. Here we see in the example, we see in case of increase and decrease in the market value of the asset, there will be gain or loss. If it increase, there will be gain. If it decrease the value, market value, it is a loss. So this is just we seen quickly. Accounting difference, accounting model, due to accounting model, there will be difference. As a result will be gain and loss. This is the same thing that just I'm gonna go quickly. Hope you guys, would you please confirm that this main concept of this unrealized gain and losses, I believe it is clear to everyone. Here we now today we're gonna see the example where we have to understand the main point. We have to see the gain or losses recorded where gain and losses. This gain and losses recorded where under profit and loss and or OCI, because we have to do the adjustment. But if already is matter is adjusted or the gain and loss is not recorded, so we will not make any adjustment. This example is a comprehensive where we understand in terms of the in market value is upper side. Okay, basis of preparing account is the accrual basis or cash basis. Because if you choose, we have the cash basis, then we do not see any of the election. Because the election, everything will be on unrealized basis. Because itself, because when we opt the cash basis, we are saying the unrealized basis just for our understanding, but practically the cash basis itself is a realization basis. The cash accounting itself on realization basis. Under cash accounting, there is no balance sheet, no accrual concept. Under accrual, that commonly we followed. Accounting asset plus the accounting asset and liability recognition and the measurement under IFRS. Okay, now here, as per the IFRS, most of in this session also people are from the accounting background and they can understand what is the PPE, property, plant and equipment. So whether these are the three different classes or only one class. What that mean of this? We may have some class with the revaluation model, some with fair value model, some with cost model. Would you please confirm quickly? Under PPE, can we have three different accounting model? Okay, now we seen the historical accrual basis. When we go through for the accrual basis, the historical cost model option, one of the option is there. The PPE, these are the three different classes: P, property, plant, and equipment. So when the standard guideline is there, when you make any accounting model, for it will be same for all the class of the asset. So which means the property is the one class. So if we choose any cost valuation method or the cost method or the fair value method, for that class, it will be same for all the asset. So which means the property may have the cost model, plant may have the fair value model, equipment may have the valuation model. This just for understanding. We are understanding this concept. All of them may have different model, but under that same clause, all the asset will follow the same model. Historical cost model. Historical cost is a comparatively more reliable. Comparatively more reliable, we can say, where the more the assumptions, the other supporting data is not used as much as where we use in the market value or the fair value or the revaluation model. There are many, some assumption may be used, but the cost model, in terms of the cost model, we were familiar the IMAR property still today also they are using the cost model for their property valuation. If you want to see that, so you can go on the Google and search the IMAR property financial statement, and there will be down the page number 70 approximate where the financial statement shown, because initially they have the other reporting 70 or 60 somewhere this is shown that. So you can check the notes of account, you will understand that also. This is the company policy, which model they will follow and which one is suitable for them. So we are not saying which one is good because each industry wise may differ. Now the next is the fair value model. Now the fair value model, fair value through profit and loss. The fair value model through profit and loss. Is there any other fair value also? Or why we are discussing fair value through profit and loss? Is there any other fair value model also? Guys, quickly. Yeah, fair value through OCI. Okay, now we are saying fair value through. Okay, we will not go through the detailed accounting standard, but what is correlation? What is the effect in the city that we just highlighting, and the further we know the accounting standard, so we can understand very well on that. Under fair value through profit and loss, recorded at fair value at each year end, which means fair value through profit and loss at every year we have to do the valuation of that asset. And when we say the fair value profit and loss, so whatever the gain and loss, it will be profit and loss account. Here increase in fair value will go income statement. Increase in fair value will be income, it will go profit and loss account. Decrease in fair value expense will be also go into the profit and loss. Under fair value, there will be no depreciation and no normal impairment loss under the fair value model. So which means when we know this part, because here we have to know only this part, because as a tax accountant or a tax consultant, you need to have this understanding, and because you have to you will receive the financial statement, you have to go and read the notes to accounts. When you read the notes of account, if you have this overall understanding of this, where the things will be adjustment may vary while computing the corporate tax. So this is the understanding what we are discussing. Use in a different IFRS: financial asset, biological asset, investment property. Now fair value through profit and loss use in different assets. The financial asset we commonly know, the investment property we commonly know, biological asset maybe we are familiar or maybe not familiar, but as the industry expert, the people will be familiar with that also. Now the next is the fair value through OCI, fair value through other comprehensive income. Now here we have to understand the difference. Here we have to understand the difference. What is the difference? Let's move quickly. Fair value recorded, okay. Recorded at fair value at each year end, it is the same. Increase in fair value income, it will go OCI. Decrease in fair value expense, go in OCI. No depreciation, no impairment loss. Simply here we are saying the fair value. This is the fair value, and will go through profit and loss. And here we are discussing fair value through other comprehensive income. Now I believe you understand what is the mean of the fair value through profit and loss. and what is the mean of the fair value through other comprehensive income. Let's move to the next. Revaluation model. Now the revaluation model, what will be the difference in the revaluation model? Revaluation model, it is the same like the fair value model. Revaluation model, it is the same as a fair value model. The timing of the revaluation organization policy may vary every year or after 2 years, whatever the organization policy. This is the one of the important. Here we are saying the first part, every year we have to do the fair value at year end. But here the revaluation, the organization or the company may have the policy. They might do every year, or they might do every 2 year or 3 year or 4 year, whatever the organization policy, and considering the applicable IFRS standard guideline also. Here the revaluation gain loss goes to the OCI, and revaluation losses will go to the profit and loss. What is the difference? And fair value through profit and loss, we are saying gain go to the profit and loss also will be go to P&L. But here we are saying the gain will go OCI and loss will go to the P&L. And depreciation will be charged. Impairment losses will be arise. Instead of that fair value, under fair value, there is no depreciation or the impairment. This is our main topic today. While before going to the exercise, this is the difference, or this is the key area we will understand why what is the impact of why we are understanding the historical cost, why we are understanding the fair value through profit and loss, why we are discussing the OCI and revaluation model. Guys, you understand the difference between fair value through profit and loss and the OCI and the revaluation model. Under revaluation model, for every year, revaluation will be not mandatory. It will go as per company policy, but revaluation gain will be go on OCI, and the revaluation loss will be go PLN, and depreciation will be charged, impairment loss will be charged. Accounting gain and losses under IFRS. This is the same that we are saying taxpayer can elect to record gain and losses on either realization basis. Why now we already go through why we are choosing the realization basis. Under the election, why we are choosing the realization basis. Election required gain, record gain and losses on the disposal of the asset or settlement of the liability. What is the understanding? Okay, no money to pay the tax. Financial statement must be prepared on accrual basis. There is two reasons. One, we are saying, okay, why we are choosing the realization basis? Because increase in value, maybe we have the gain in the current year, but to manage the cash flow, we will say, okay, in future when we sold, then we will pay the tax. So mostly the company, if I'll share my opinion as per my understanding, that may not fit to the every organization, but more likely it will be, you guys also agree, option B will be more or less will be suit for most of the organization, except as per the specific industry operation. But more likely because the capital gain, the revenue, capital asset, this is one of, and whatever the the gain, if we are recording the valuation in the current year, we'll pay the more tax. On the other side, if we choose the option elect, that we will pay the less tax in the current year. This is the irrevocable. We already go through for capital asset and liability only. Here we seen all asset, all liability, unrealized gain losses, capital account for long-term asset and liability, PPE, that we already knows, that we already know on that. Revenue account from short-term asset, liability, inventory, unrealized basis, which means automatic. If you opt for the, if while making the election, you select no, by default, you will be go on automatic unrealization basis. capital account, taxable, and revenue account also will be taxable. For financial institution, only election B is available. For financial institution, only election B is available. Ms. Rana, this is the one of the point that you were asked for that. Mostly we covered based on the previous understanding and the question from the participant as well as from the client. So I'm trying to cover the points in the beginning, in middle, or in the last of the same topic. Okay, now the first gain and losses under IFRS and accrual accounting, taxpayer can record the gain and losses on realization basis. Realization basis election is required, loss on disposal of asset and settlement. Simple example, this just for initial example, fair value model. Profit before tax is a $500,000 gain on and losses on realized basis elected. Okay. Cost model, cost of the asset is a 100K. First tax period, this is the first tax period is a 2024. Market value at 31st December is a 120 market value at the year end. So we have to consider the market value of the asset is a 120. Asset here was 100. So we will start from the 120. Asset at 31st December AD and the 200 gain in the profit and loss. So what we understand over here, this is the very important, on which date the asset value we are taking at the year end, and our market value at the year end is 120K. And what is the asset cost? If we the cost we have the 100K. So now we will see that how much the change in the value is a 20K gain. Where it will be recorded? Profit and loss. Guys, I appreciate if you quickly respond on chat also, because that will show your presence and your active cooperation in the session also. Now, please let me know why we not charge the depreciation. Why we not charge the depreciation? Why we are saying the only 20K will be different? Maybe there is a depreciation. After depreciation, this value will be changed. We will calculate the depreciation. Just most of the people are understanding the concept. Just quickly, yes or no? We will charge the depreciation under this example, yes or no? Yeah, because I will make it simple to just to take your understanding, and with the minimum text typing also, that will save the time also, and it will be we continue. Okay, here now we have the 20K city competition. Thank you, guys. Let's see the next example. Election made to record gain and losses on realization basis. Remove any gain or losses from the profit before tax figure, only those recorded in the profit and loss, not the OCI. Election made to record gain and losses on realization basis, the same that we understand. Remove any gain and losses from the profit before tax. This again, we are just summarizing the previous understanding. Which adjustment we will make under the realization basis? We will adjust or will add back or deduct only the amount that already part of the profit before tax. Profit before tax. Now under OCI, we've seen our city competition is not starting from the OCI. OCI means the TCI. After OCI, other comprehensive income, the total bottom line will be TCI, total comprehensive income. Our calculation is for city competition is started from profit before tax. Profit before tax, and that's why, so accordingly, if anything recorded in OCI, we will not make any adjustment. Okay, let's move to the here just for understanding. Here for the same example is saying remove or less gain of 20,000 from profit and loss before tax, as this is not yet realized. What does this mean? Now we are doing the city competition. Here we understand what is the gain, okay, and where is recorded, where it is recorded, just for our understanding. If this 20,000 recorded in PL, so here we are saying remove any gain or losses, profit before tax, only those recorded in PL. So this 20,000 recorded in PL. So we are making the adjustment. We are gain means we already increase our profit. Now we will remove mean less mean we will exclude this gain. We will not pay the tax. Yes, decrease the profit as it is not here. Keep under capital account and accumulate figure in the future year in which asset may be sold. Asset will be sold. Okay. Now the same unrealized gain and losses will be recorded, will be taxable. I just wish to take the few-minute break due to prayer. Azan is there. Just give me the few minutes. Okay, now here we've seen unrealized gain and losses will become taxable. Here the same amount that we are adjusting, the same amount we are adjusting, it will be, the word is used crystallized. Now in the current year where this gain is, we already exclude from our city computation, but in future when the asset will be sold, we will pay the tax on this amount. Relies on disposal of asset in the tax period of disposal. Hope this point is clear. Hope this point is clear. And this 20,000 will be our deferred tax asset or deferred tax liability. The gain that 20,000 we excluded, so this is our deferred tax asset or the liability. Ms. Rano, we are coming to the example. Let's move to the quickly. You will understand the topic also. Just give me 1 minute. I'll just see the example. I'll add the example over here. I think that's the next topic. Meanwhile, if you have any question, please make in chat. So I'll just quickly add the question also, example also. Okay, let's continue. I think this is fine. It's fine. We'll continue the same. Example is there after 1 or 2 slides. Here the simple example cost model ABC company prioritization base elected. Here seeing the cost is a 100. The first tax year is a 24. Market value of the asset is a 120K. Here the market value here the market value will be 80,000. The market value of the asset is 120,000. Net book value Okay, quickly, again, I'm just going back to this. The cost model, profit before tax, 500,000, gain and losses on realization basis, we elected the cost of the asset is a 100. At the beginning of the year, first tax period is a 24, market value is a 120K and net book value is a 80K. So now let's assume that our net book value is 80K and the asset during the next year at the 35 after 7 months, and next year asset is sold as 150. So now we are seeing when the asset is sold, how it will be realization. What will be the transaction or the adjustment we will record over here. Election made on made to record gain and loss on realization basis, remove any gain and loss from the profit before tax. This is the same that we already seen in the previous example. Unrealized gain and losses will become taxable or crystallized on the disposal of the asset in the year of the disposal. So this year in 2025, asset is sold. When asset is sold, so what is the gain previous year we have? That is the 20,000, the gain from previous year is coming. If we just take the previous example, we have 20K, the gain that we are carrying forward. So 150 is the asset sold. So give me the calculation. So if we have 20K, 20K is the gain from the 2024 and 2025, the asset is sold at 150. So how much the gain will be taxable? The year of sale, that is the 2025. Do you understand the point that we wish to understand here? Okay, now in the most of the people is saying the 70K because some is say 50K. 50K in the current year, as we seen the 100 plus the 150, the 50 plus 20 previous, so total is a 70. Okay, let's move to the next. Remove any unrealized gain and loss arise at the first year of tax period from the gain on the disposal. Asset must be at the cost that we already learned in the previous. Okay, now let's see the next. Guys, this is the answer that I hope you guys understand the detail. You already take the concept. This is the 50,000 gain in the year of sale, and this is the 20,000 that earlier we have. Okay, now the next example. Consider the adjustment required other than upon realization in case of asset where the net book value exceeds the original cost. In previous session, we discussed this. The asset is not a financial asset. Adjustment of accounting other than upon realization. In this example, asset will not be sold, so we have to understand without sale what will be other adjustment. Now we understand this example, consider the adjustment required other than upon realization in case the asset where the net book value exceeds the, okay, here the main point, net book value exceeds the original cost. And this is not the financial asset. Company B acquire a building from a third party, $500,000. Now here the point we coming acquire the building. Is there any concern point or relevant point that may we have to consider? In two sessions before, we discussed some topic about the interest capping rule. Can the interest capping rule from this building will be part of that? If this building is, if we construct this building, it will meet the qualifying asset, then we will consider the interest capping rule also, because that building capitalization cost maybe have the interest portion also, finance cost also. Okay, so here we are saying accrued. Okay, so this will not be qualifying asset, we don't have to consider that interest capping factor also. We do not we will not look to the interest capping factor. Let's continue the same way. Company B acquire a building from third party at a $500,000. Next is a tax period and at the first. Now, if he's saying the tax period end, so which means, so this value is already at the market value or at the with depreciation already adjusted, whatever, we don't have to do the again the depreciation. He already mentioned end of the tax period. Record its net book value as $500,000. On the net book value, they are recorded as a $500,000. Company B has elected to take into account the gain and losses on realization basis. So here we understand the realization basis and which option. And which option, realization basis, which election we opt here. Would you please confirm? Which option we opted? Guys, quickly. 32 participant is shown, and the 32 is not actively responding on that. The mostly names I know, so they are coming on that. And these names are not 30. Guys, if you are coming only for the certificate, so I appreciate you may have the certificate other way around also. But if you came for the learning, that is the main objective, the productivity. So I appreciate participate on that. Shown your interest. Okay, now held on capital account. Now let's move the next at the beginning of the tax period 2. Now we're seeing at the beginning of the tax period 2, company B revalue the building to the 600. Here is an important factor, beginning. Okay, not year end. Which means depreciation may be coming or maybe not coming. We will see in the detail. But as of now, what we understand, the company B revalue $500,000 and the revalued amount is 600. So how much the gain? How much the gain? The change in value is 100, reflected in the accounting income represent on unrealized gain. The change in value is 100, reflected in the income statement, unrealized gain. Since the company B has elected the realization basis, it should exclude the unrealized gain from its taxable income in the period 2. Is the here, can we exclude from our city computation in the period 2 or no? Yes or no? Excluding? Yes or not excluding? No. Yes, we will exclude because we opt the option is the capital account on the realization basis. So this asset is already part of the profit and loss, but we will exclude that. Company B depreciate the building using a straight line method over 10 years. So here, the key point we've seen the beginning of the tax period, and now we've seen the option is a 10 year. Okay. So at the beginning, year one, the value is the $500,000, okay. And the next year, the year two, the 600, then which means the depreciation also we have to calculate. And over the 10 years, over the 10 year, starting from depreciation, starting from, because we purchased at the year end one, so from second period we will start. The result, accounting depreciation is 60,000 per year. How much the change in depreciation? How much the change in depreciation? And what we will do, this depreciation is our allowable expense or no? This depreciation is our deductible expense or no? What we understand in the last session, in case the revaluation is arise is more than the original cost. The original cost is $500,000, and here is the 6 million, the revalued amount, and the even the depreciation per year it is coming 60,000. 50,000 part of the $500,000 and 10,000 part of the additional. But this is the accounting and bifurcation. This is the accounting bifurcation 50 plus 10. But what is the topic that we learn? How much the depreciation amount per year is 60,000, and how much amount we will deduct in the year two? How much amount we will deduct in the year two? Is the depreciation 100% deductible allowed in the year two? Come on, guys, quickly. Even you giving the inappropriate answer, that doesn't matter. At least whatever the understanding that you have, you're sharing with me. So based on that, I'll keep continue the next also. Not allowed 100%. How much amount? Amount, please. How much? Now we have the depreciation in year two is a 60,000. Can we record in the profit and loss? Yes or no? If it's yes, how much? If a no, 100%. Yeah, Irtada Bukhari, 60K not allowed. Okay. This answer, even right and wrong, that we will see later on, but answer is complete. Yeah, next Asif Khan, 50K allowed and 10K not allowed. Okay, this answer is also complete. Irtada Bukhari and Ms. Farhana, Mohammed Tayyib. Guys, please. Anyone would like to come forward and volunteer himself to explain this? I'll take the few names. Irtada Bukhari, Farhana, Mohammed Tayyib, Ms. Kinjal. These participants have the correct answer, but I would like to understand what is their understanding, and one from the other side also. Yes, Ms. Rana. Now you consolidate the whole discussion until it is less than original cost. The amount of the depreciation that fall below the original cost is a $500,000. If the amount of depreciation that decrease original cost, that will be allowable. There is another person, Mohammed Asif Khan. Okay. Asif Khan, would you please unmute yourself, and would you clarify what is your understanding? You're giving 50 allowed and 10K 50K allowed, 10 not allowed. Please unmute yourself. Mohammed Sahab. Mohammed Shah, would you please unmute yourself? Guys, is there any, Mohammed Shah, are you available or any difficulty? Are you?
Can you hear me, sir?
Yes, please, yes.
Assalamualaikum. Sir, 50,000 is the cost and 100,000 is the gain. So 600,000 is the value coming. So we can do the depreciation for 60,000 and in this year. And because up to the value of the gain, that is 100,000, it is allowed. So the next year it could be 40,000. So the first year it is not crossing the threshold of 100,000 gain. This is my understanding.
Would you please repeat again the point?
So my point is the cost is 500,000 and we have a gain of 100,000 and the unrealized gain as an unrealized gain. So we can have the depreciation of up to 100,000. So first year of 60,000, which is depreciation is allowed, and then the next year it could be 40,000. Maximum value up to the gain of unrealized gain.
So that much amount of the depreciation we will not record in the P&L, right?
We can record.
This much amount will not record in the profit and loss, or we will record like the 60,000 in the current year.
We will record, sir.
Record in the profit and loss or no?
We will record up to 60,000.
Yeah, and this will reduce our profit in the current year. 60,000, the current year profit will be reduced, and the next year 40,000 will be reduced. Right. Like to take one more participant who would like to. Yes, Ms. Kinjal, would you please unmute yourself?
Hello.
Thank you, Mr. Shah.
Hello.
Yes, please, yes.
Yeah. So right now, as of 1st of January 2024, company did the valuation and the value reached to 600,000. So for that, now the remaining life of the asset will be 6,600K divided by 9. It will come as 66,000 something. So net value as of 31st of December 2024 will be 533,000, which is more than the original cost. So that's why full depreciation will be not allowed, because we selected on a realization basis.
Okay, now just summarize the point. 60,000 is the depreciation. That 60,000 you're saying is not allowed to deduct in the current year, right?
Yeah,
So why we not allowed the 60,000 in the current year?
because we did the valuation. The valuation gain is 100K, which is more than the original cost of 500,000. 100K is the actual gain, and if we calculate the net book value as of 31st of December 2024, or say second year, that is exceeding the original cost. That's
Okay, thank you. Okay, guys. Yes, the point is that we have the very detailed understanding in the first session. To understand this point, most of the participants given the near to correct or mostly given the correct answer. Here, the point is that this is the we have the realization basis. This is the one point, and the second, we are saying if the realization basis in the year of sale, whatever the gain or loss on that, we will pay the tax. This is a simple definition. If we choose this option, so the current year, we have the increase revaluation 100K. So this 100K, what is this 100K? This 100K is our deferred tax asset or deferred tax liability. Just now, most of the people give the answer on that. This is the deferred tax liability, which means in the future, we have to pay the tax on that. In the future, in the year of sale, we have to pay the tax on this. Whatever the exact value of the sale and plus this year. In previous example, we just now seen the previous gain, this is the 100K. In the previous example, I'll just go quickly. Here, what are we looking for? Asset is sold on this value. In the year of sale, the asset sold at 150K. What is the asset original cost? 100K. From 100K, the first year, 20K profit. The 20K profit that we said it will be carry forward and remove from the first year. So this is the 20K, we said the gain at the start of first tax period. Again, this gain, we are not calculating against the 80,000. We are not calculating the 80,000. We are saying the 100K is the cost, the base cost, the original cost, plus the how much the disposal at 150. So 150 minus 100K, this is the our gain. Now this gain is a taxable. So what is the calculation? He's saying that actually our gain is a 50,000 or the gain that we have the previously. This 20K we already have. So actual gain is a 30,000 against this. Against 150, actually our gain is 30,000. Why 30,000? Because 120 gain already we recorded as a deferred tax liability plus we sold at that. So actually the 30K is the additional amount on that. So now the next example, it is the same point. It is the same point. Now in the year 2, we have the 100K as a deferred tax liability. And we are saying whatever the depreciation above the exceeding the original cost will not be deductible. And that depreciation will be go to the deferred tax liability or asset. This depreciation 100K, we said 100K here we are saying this is the liability and here the 60K is going in the deferred tax asset. Guys, quickly, hope you understand the 100K is a, just write the 100K asset or liability. DTL, 100K is a DTR or DTA. The short form mostly the people is using. And the 60K is a DTA, deferred tax asset. Now, here, since the company B has elected the realization basis, when calculating the taxable income in the tax period 2, entire 60K depreciation shall be added back. Why? Because in accounting, we already deducted. Thank you, Mohammed Tayyib. You consolidated the answer. You consolidated the answer. Company B on realization basis, and in the period 2, entire 60K will be depreciation will be added back. Why it's added back? We are saying this 60K the deferred tax asset. So why we are adding back? We should deduct, right or no? We will add. Okay. Okay, we are here what we are saying, we will add back. Okay. Shall be add back. Why? Because in accounting profit, the accounting team, they already charge as a depreciation and they expense out, which means our accounting profit is on lower side. But actually, we do not have to deduct this expense at the first point. So to bring in the original shape as per the tax city computation, because the accounting team is already minus, so we will add back now. As it's related to change in the net book value exceeding the original cost. So this is the point 60K to the 540. Now we'll cover 3-year this example. So as of now, our asset value is from 600 to 540. Assume accounting profit and all years are 200K. Here we're taking the, just for assumption for understanding, we said that 200K is the accounting profit. Company will continue to adjust for the depreciation until it brings the asset net book value to the amount that is equal or less the 500 original cost. Hope this point is very much understand and clear now. Therefore, in the tax period 3, it will be needed to add back 40,000 depreciation, because now depreciation will be 60,000, but the 40,000 will be above. So we'll add back 40,000, which is the remaining depreciation relating to the net book value exceeding the original cost. This result in 20,000 depreciation to be allowed in the determination of the taxable. So here, because in the first year, we have 600 minus 60,540. Net book value from the previous year is the 540, and this year additional 60,000 depreciation. Hope you guys understand. Let me just make this. Now this is the net book value. Net book value from the previous year. How much the depreciation? How much the depreciation? $60K. So what is the original cost? Original cost of the asset is this one. Up to this is a disallowed. So which means if we say that 40,000 against this 60K is a disallowed, after disallowed, this value will be equal to 500K. And the balance 20K, because it's below the original cost, so it will be allowed. It will be allowed. Okay. So let's move to the next. Let me just. In the year 4, company B shall not make any depreciation adjustment. The full amount of depreciation will be allowed in the determination of taxable income. Where he's saying that tax period 4, because 540 minus 60. So what is the net book value? 480. So tax period 4, 480. So this is less than 500K or more than. So if this 480 is less than 500K or more than. If less than, so we understand all the depreciation now onward will be allowed. Let's move to the next. year one, building carry value, opening balance, 500,000, appreciation, no appreciation, because the change in value happened at the year end. Accounting depreciation, no adjustment, because this value came at the year end, the important factor. Now our working start from the tax year period 2, 500,000. Value was 500,000, it will go appreciate this 100K, and the accounting depreciation 60K. I'm just summarizing. The tax period 3, so now because this depreciation is deducted against the 600, is deducted against the 600. So this is minus 60K. So 540. This depreciation from the because the asset value, market value, the 600 against depreciation is 60K. So now this, an accounting depreciation, how much? The 60,000, and 60,000 we said disallowed. We will add back. We will add back. Mostly we are maybe confused add back and not add back, deductible, not deductible. If you understand the concept, what is happened before, after that, what you have to do, then you will make the adjustment. Now here is the 600 minus 60, 540. So here will be accumulated depreciation. Accumulated depreciation 60 plus another 60, 120. Right? Depreciation for this year is 60. Let's see the next in more detail. Building net book value 500,000, pre-depreciation accounting income. We said the profit. Okay, the profit, accounting profit before depreciation. Pre-depreciation means before depreciation. EBITDA. Okay, earning before interest and tax. We are discussing that. Accounting profit before depreciation 200. Accounting income is 200. Okay, because accounting income and EBITDA both are same. There is no other adjustment. So taxable income is 200. As long as we are just keeping a simple example for understanding. So in this taxable income adjustment, disregard unrealized gain 0. Taxable income adjustment, add back depreciation 0. Okay, because at the year end, this calculation has started. The year 2, we understand after the depreciation, net book value will be 540 because 600 minus 60K is a 540. Here the 600 minus accumulated depreciation 120. Here 600 minus accumulated depreciation 180. So pre-depreciation 200, it is same all the year. Then the accounting income 140. Why is 140? Why this is 140? Anyone can explain this? Why is 140? On the one side, we are saying the 60,000 depreciation is disallowed. So why is 140? Guys, it's 140 because we have the depreciation, this depreciation. Because currently the accounting team is working. So what they did, they said this is our account EBITDA, this is our accounting profit, this is same. Then we minus from here the 60,000, 200 minus 60,000. So this is the because as of now we are assuming accounting team is working. Accounting team is working, so they did the as per accounting 140 is the accounting profit. Now we have the unrealized gain. So that we said it would be deferred tax liability. So that's why we minus from here. Then we said the tax, this 60,000 is disallowed. Disallowed, we will not deduct as this is the exceeding the original cost of asset. So we will add back. Why? Because this is already accounting team deducted. This is deducted, we are adding back. This is the already added, we are minus. So taxable accounting, taxable income is 100K. After doing all this adjustment, so taxable income will be 100. Why 100? Because we are saying this 100 is a unrealized gain. This will not be taxed in the current year. So this is the summarized example where we've taken some assumption and we are continue the concept. And the next year we said the 120, 200, 140. Because again, this year 60,000 depreciation, but here the 40,000. Here is the 40,000. The depreciation is disallowed. 40,000. Hope you understand 40,000. What is the 540? Then here we have the breakup of 40 plus 20. So 20 is allowed depreciation that they already they deduct the 60,000, but 40,000 will be added back. And the same concept here in the year 4, all the depreciation is allowed and will continue. Hope this example refresh your previous understanding that we learned in the previous session. Let's move to the next. Hi guys, we are back. I'm really sorry due to some IT issue. I don't know. It's restarted the Zoom, and after restarting, Mr. Tayyib become the host. Anyhow, thank you, Mr. Tayyib. I'm audible now. Just gonna share the slides again. Okay, guys. Due to some IT issue, apology, something went wrong and Zoom is restarted and Mr. Tayyib become the host. Anyhow, now we are back. Next example. This question considered the adjustment required other than the upon realization. The same. Other than the realization means the asset in asset sale. Okay. Now earlier we seen the upward revaluation. Now we'll see the downward revaluation, where the net book value below the original cost. What is the net book value below the original cost? So earlier we seen in the same example, earlier it was the 600, 100K was increased. Now the 100 is a decrease. The same example, other way around, we are considering that here. The company B, okay, the same third party at the year end, 500K at the year end. Quickly, net book value is a $500,000. Same example, everything. B made the elected again gain and losses on realization basis held on capital account. Option B. Now the company B revalue building to the 400. So this is 400 means initial was the 500. Now it is the 400. This is the original. This is the original, and this is the revalued. Okay. Hope you guys understand what is the meaning of. Now this is the period 2, and the change in value is 100. Reflected means accounting team already made adjustment in the income statement and unrealized loss. Okay. Now the company C elected for the realization basis, it should be excludes. We're saying exclude is already included. This loss is already minus. We're saying we will not minus. In the year of sale, we will minus unrealized losses. Affordable. Yeah. Okay, now we're saying excluding the unrealized loss 100K in the determination of taxable income in the tax period. The same example, the point we're going to understand earlier was that depreciation is more. Now the depreciation is a lower. The company B depreciation on the building using the straight line method over the 10-year, starting from the tax period 2. The resulting accounting depreciation is 40,000. So every year 40,000 depreciation. Now this depreciation is a deductible or not deductible? This depreciation is a deductible or not deductible? Guys, quickly, this depreciation 40,000. This is deductible, not deductible. Most of the participants is not deductible. Umar is saying part of PLN. Why most of the people is saying is deductible? I would like anyone would like to come forward and explain this, why is deductible, but quickly, only the 60,000 depreciation, focus on that. And please quickly, if anyone, any participant. Mr. Asif Khan, would you please unmute yourself? Mr. Asif Khan, would you please
Hello.
unmute yourself? Yes,
Hello,
please.
can you hear me, sir?
Yes, please. Yes.
Sir,
Yeah, please.
actually, the original value is 500K, and they made the 100K less. So if the depreciation is 40K, so it's not changing the result in the tax deduction. So that's why we are able to deduct that amount.
Okay, we understand the depreciation if less than or below the original cost, that depreciation will be allowable. Because this is the routine depreciation that you are continue doing from previous year also. So that amount do not have any component of realized or unrealized part, right? Because that itself, the asset or the tax period is started is the same value. So whatever the amount against the original cost as a depreciation, that will be routine. Previously we are deducting, and currently also we are deducting. The main point, the net book value after the depreciation is below the original cost. Whatever the below, the same amount will be deductible. So here is 100% amount is below the original cost. And the accounting team already deducted, so we are saying no adjustment is required in the depreciation relation and particular 2, 3 respectively all the year, because will not result in tax deduction above the original cost. Okay, so earlier we seen the increase in original cost. Okay, the market value was more. Now we seen the below the market value. Let's move to the next. Thank you, Mr. Asif. Company A acquired the building 500K at the end of tax period. Net book value B has elected into taken gain and losses on realization basis. Okay, same example. Okay, company B revalue the building to 600K at the beginning of the year 2. Okay, fine. Change in value is 100K reflected in accounting as unrealized. Company B elect for the realization basis. Fine, it should exclude the unrealized gain from its taxable income. Period 2. Company B depreciation using a straight line method. I think this is the same example again. Yeah, this is the same. Now, this is the next example. Company X sell home appliances. This is very important. This is the very home appliances. Okay, while I'm mentioning the nature of business, what is the nature of business? What is the nature of business? It's B2B, B2C. Due to the market development, company X consider that it will have to discount certain product due to market development. Okay, market development due to change in prices in order to sell them. Accordingly, it record a write down of 100K at the end of the tax period. Write down at the end of the tax period. At the time of company X still own the inventory. So the loss recorded in the company X income statement is unrealized. So now this is the capital item or the revenue item. And which election will be applicable? And which election is applicable? Okay, company X has elected to take into account gain and losses on realization basis. On realization basis. Most of the people is mentioning the A, and let's see what the example is saying. In relation to all asset and liability held on capital account. So here he choose the option B. Here he's saying the capital on account, and some people are saying the A, some people said the B. So do you understand so far, or still you have any confusion? The line item are the point that we are understanding, that is the revenue item. That is the revenue item. And we can take the election as a capital, even though it's a revenue item. Now, at this scenario, we have the capital account at the election inventory is an asset item held on revenue account. Fine. And is not covered by the election. Do you think is correct? Is not covered by the election? Do you think this is correct? So what will be adjustment now? What will be the adjustment quickly? What we do? This 100,000, they write down, what we will do? No impact. Why no impact? This 100,000 is a deductible expense. First, we have to understand the 100,000 is a deductible expense. Yes or no? Just write 100K deductible. Yes. Okay, deductible. Yes, 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 yes. Okay, now we are saying these are deductible, and now in to compute the city taxable income, we do any adjustment. Most of the people are saying no adjustment. Why? Because it's already deducted by the accounting team. We have to deduct, but is already deduction is done by the accounting team. We will not do any adjustment. So it should not adjust in accounting computing the taxable income. Respect of unrealized gain impairment losses, the realized loss should be included in the taxable income. Okay, H LLC made a profit of 1 million from its taxable activity. H LLC made a profit 1 million in its last tax period. At the end of the period, company had unrealized gain of 100K on a building. An unrealized loss on the trade stock. There's a two items is involved now. We have the gain and we have the loss also. Accounting profit is 1 million. Then we have the unrealized gain 100K. Then we have unrealized loss 20K. And what is our election? Here he made the election B. Election B is a capital. So first quickly, this 20K is a deductible or no? Yes. Some people saying the deductible, Irtaza is saying no, Khalil is saying no, Asif is saying no. Guys, why is no? Why is no? we opt for the election B. If we opt for the election B, which means only the capital gain and losses, that is not the deductible. The revenue means the current revenue item will be deductible on unrealized basis. This is the unrealized basis. This is the realized basis only. This is the realized basis only, because under capit option B, this is only falling. This is the tax adjustment. When we talk about only the asset held on capital, this is the adjustment. And this will be as per the accounting treatment, because we choose the option on the unrealized basis. Whatever the accounting team done, we will not do anything on that. So this is the complexity or the confusing part there. We have to do the adjustment or not to do the adjustment. First, we have to see what the accounting team is made the effect. Okay, let's see the okay. Now the same example, LLC made profit from its taxable activities. Last tax period at the end of the tax period, same example, everything remains same, but only the option, this is change. Now, guys, tell me what will be the effect now? Here again, two part is there. Same 100 and here is the 20K. So which one is the deductible and which one is not deductible? Twenty K, people are saying 20K. Most when he's saying it from mostly people giving answer 920. You guys understand this 1 million from tax at the end of the last tax period, which means this 1 million, this 1 million already have the impact of both of them. Both of them already adjusted. Already accounting team already give this adjusted figure. This is the profit before tax. Yes, Mr. Khalil. 20K will be added back. 20K will be added back because this is now option A and this is on realization basis and this will be on realization basis, right or no? Guys, quickly, be with me and just quickly confirm that. Quickly, please confirm that. We will do the adjustment for 100K and 20K both. Are only of 20K or only 100K. Guys, quickly, what will be the our adjustment? If we are assuming 1 million having the effect of both figures, 100K unrealized gain on the building, 100K and plus the 100K is added to become the 1 million. And we are choose the option of election A, all asset on realization basis, all asset on realization basis. Thank you, Mr. Hamza Zufel. Both, okay. Thank you, Ms. Kinjal also. Shahab, Mr. Shahab, would you please confirm again, Mr. Shahab? Our option is election A for all asset and liabilities on realization basis. Still anybody not understand? See guys, if you give the answer and I explain, if you understand, just mention that updated answer. Okay. Ms. Farhana not yet respond on that. Who's left? Who's left? Shahab, Adnan, okay. Mostly the people who asked the question. Azam Iftikhar already gave the answer. Irtaza Bukhari. Would you please confirm your update the answer understanding now? Irtaza Bukhari, please. Khalilur Rahman, Mr. Khalilur Rahman, please reconfirm. Mohammad Badr Sadiq, please reconfirm. Azam Iftikhar. Asif Khan. Okay, let's move to the next. So this point is very much, pretty much understood. Okay, now Irtaza Bukhari still said not understand. Okay, let's make one more understanding. Just and Ms. Farhana saying the taxable income. Okay, the taxable income will remain the same because we said both adjustment, both will be both will be carry forward. Both will be carry forward. Yes, it's not the same. Both will be carry forward. So what we will do? So let's say the 1 million and let's say the 1 million, the profit before tax, in which included the 100K gain. Because the 100 gain already recorded. Without gain, it would be 900. And then 20K. 20K unrealized loss, which means we already minus. So now we will add. How much the effect? How much will be the taxable income? How much will be the taxable income? Okay, Miss, there is another question of the party. It's a okay, there's one more participant before Miss Farah, same. Okay. Okay, Miss, it's the Bukhari. Just I'll summarize again. Let's take this figure. Okay, how become this? Now you have to go from here, the reverse. Okay, so what happened? This 1 million, how it 1 million? Because here we added the 100K and we minus the 20K. After having these adjustments, this amount, this profit, we have it. This is from last tax period. Now we are seeing the election A, where we seeing the capital asset as well as current asset, both will be on realization basis, both on realization basis, which means any impact as a result of market exchange, unrealized gain and losses. And so because this inventory is still with us, it's not sold. So whatever the decrease in value, this is unrealized, so we will add back. We will add back. This 20K will add back. This is the revenue item, and this is the capital item. And the capital, because option A, so here is both revenue plus capital. Hope is covered. Clear, Mrs. Please confirm. Hope is clear. Let's move to the quickly. Let's see the next example. HLC made a profit of 1 million. Taxable activity in the last period, same example, at the end of company has unrealized gain. Please understand on building which is recorded in the OCI, which is recorded in the. This is the another understanding that we OCI. An unrealized loss on stock recorded in profit and loss income statement, and election B is the choose. Now, please give me the answer on that. Please give me the calculation quickly. Now I'm just writing the amounts and you guys will let me know what will be plus and what will be minus. We appreciate other participants also. But first we said the capital, okay? In terms of what the adjustment on the capital. The capital is the building. In terms of trade, it's irrelevant. Why? Because there is no election on that. This is the no election. No election means unrealized. We did not choose any election on that. So which means whatever the accounting team did, that will remain same. Right? Now the second is election B is fall on the 100K. So 100K, they already recorded in OCI. They already recorded in OCI. Okay. So this is no adjustment. And 100K recorded in OCI, which means this 100,000 profit. This 100,000 is the accounting profit. Do this 1 million have the impact of this 100K? Did this have the impact in this profit before tax? This 100K is adjusted here or no? Yes or no? 100K have included in yes or no? This 100K, yes or no? People is saying yes. Mostly people saying this 100K have the effect in 1 million. Then why he's saying unrealized gain of 1 million building, which is recorded in OCI, which is he already mentioned, I already highlighted This is recorded in OCI. And this is the profit. This is not the TCI. And we start our city computation from the profit before tax. And this is the other comprehensive income. And this 100K, this 100K, okay guys, this 100K, because he already mentioned the no effect in profit because this is recorded in OCI, that's why this also will not affect. We will do the effect if already some adjustment is made. Here the option B is chosen, option B only for capital asset because the 20K is already deducted is fine. But here we saying the 100K, we will make the adjustment because this is on realization basis. But when we see the 100K, we choose the option is OCI, is already recorded in OCI, then no adjustment. No adjustment, no adjustment, it will remain 1 million. It will remain 1 million. So now please confirm, you understand the point, it will remain 1 million. Guys, quickly. Election B have the effect, but their unrealized gain is not recorded in PLN. It's recorded on OCI, other comprehensive income. That's why no effect. Let's see another example. HLC made a taxable activity in the last tax period. Okay, HLC made a profit. This is the same example, continue in a different scenario. Accounting unrealized loss is 100K on an equity investment. The word equity investment, which is recorded in the OCI, Other comprehensive income, and unrealized loss 20K, trade stock, okay, current asset, revenue asset, all right, the revenue item, which is recorded in PL. The same option earlier, we have the B, now option A. Now, please give me the answer now. Everything is remain same. Would you please confirm now? What will be the answer now? Now we choose the option A, same example. Quickly, our session time already over. Okay, the 20K will be added back because this is already adjusted in the PL. The other is not added, so that we will the building is have the effect in OCI, no impact, so will not. 20K we have to add back. So taxable income will be 1,020,000. Now let's move to the next example. Okay, the 1 million taxable activity unrealized gain is on building unrealized losses 20. Okay, I think we already seen this. So noise coming again. Okay, guys, thank you very much for today time. We'll come back in the next session and we'll continue the new topic, the transitional gain. Okay, that will be our next topic. And I appreciate if you guys do some practice. And meanwhile, just after 2 minutes, I'll share one link for the attendance also. That will be quiz. So quickly complete that quiz. But I'm stopping the meeting and I'm sharing the link quickly in the group. Thank you. Anybody have any question, please? Anybody have any question, please? Hope you guys understand the unrealized gain and losses. This is a very comprehensive with understanding, and plus we already have this one YouTube recording already available that also I try to explain in the appropriate way, and here is also I covered in very much in detail. Thank you very much.